My name is Teresa Bailey. I'm a wealth strategist and also director of development for Waddell and Associates. Welcome to the Bottom Line Lunch hosted by David Waddell. Typically, if you've attended one of these in the past, they have been in person around a table as we share a meal and share ideas with each other as well. Hopefully, we'll be back to those in-person events very soon. I believe everyone here does know David, but very briefly, he is our CEO and Chief Investment Strategist. And with that, I'm going to turn it over to David. And David, would you please tell us more about the 1980s? Take us back.
I will. I'll get the flux capacitor agenda. All right, guys. Well, I'm excited to have y'all virtually around the table. I'm assuming at some point we'll get back to being physically around the table. I chose the title slide for this presentation. It's time to cut loose, because right now the economy is growing at a rate we haven't seen in 4 decades. And so my goal today is to have y'all singing and dancing and celebrating by the end of this presentation, because we should be just as happy as we were back in the early 80s, assuming that you all were happy. Prosperity tends to promote happiness. So there's a lot of prosperity around, there's some anxiety around, but ultimately, I think the world is in a pretty good spot for us as economic participants and as investors. That's what we're going to talk about today. But before we do, you have a reading assignment per the usual, and I'll give you a moment to read that. Well done. All right. So as many of you may recall, last year we did have a pandemic. And I'm going to walk you through a little bit of the framework that we used to navigate through the pandemic, both projecting the economy and also forecasting markets and positioning ourselves accordingly. You may recall this slide. Yes, it was a pandemic. Instantly, we went to work. There had been other pandemics. There was the Spanish flu in 1918, the Asian flu in 1957, and then an echo virus, 1968, Hong Kong flu, and then the swine flu in 2009, which was contagious, but fortunately not all that lethal. What made the Asian flu so interesting to us is not only was there a pandemic, but there was also a recession, and there was also a bear market. So digging into that detail just a little bit, the economy recessed in the first quarter of 1958 by 10% on an annualized basis. That was a significant drawdown in the economy, the largest that we'd seen since the Great Depression. And it was a function of voluntary quarantining and social distancing. So economic actors got very nervous because of the Asian flu pandemic, and they opted out of the economy. They went home, they quarantined, and that's what created that drawdown. But again, it wasn't mandated, it was voluntary. Soon after that, we received a vaccine. Confidence in the economy returned. Everybody was so excited that they survived that the economy started growing at 9% plus, and it did that for over a year, which was significant and pretty unprecedented. And so this framework sort of gave us courage, if you recall, to get a little bit more exposed to the stock market in the midst of the melee last March and into, I guess, the 1st of April. So knowing that the human spirit will celebrate survival, celebrate the animal spirits, we got engaged. In COVID's sort of retrospect, the government lockdowns just exacerbated, if you will, the negative drawdown on the economy. So for the first quarter, we were down 5% last year. In the second quarter, we were down 31%. And so they had dragged the economy, which had been pretty buoyant, growing at sort of that 2 to 3% pace we'd been used to. But participation levels were rising, and there were some positive economic indicators. We got sideswiped. And so they pulled the balloon down. They pulled it down to a historic extent. So there was actually a $2 trillion drawdown in the economy in that first, 2 quarters of the economic recession. 2 trillion amounts to 10% of the entire US economic size, being that the economy runs about 20 trillion. But don't fret, while the government may have pulled that balloon down, they also inflated it basically at 6 times that amount. And so a $2 trillion loss in the economy was offset by almost $12 trillion. Actually, I should say 12 trillion plus in stimulus, given that Biden, I think, has another 3 trillion or so on the docket. And then there's another whisper of a trillion. It's hard for me to even keep up. But between the Fed's work with quantitative easing, which, by the way, still continues at 120 billion a month, and then the loan guarantees that backstopped, businesses and households, bankruptcy attorneys are kind of starving right now because of all of that. And then you've got the fiscal stimulus that came in really 4 tranches. That's now totaled up to 5.3 trillion. So yes, we had a drawdown of 2 trillion, but we've had an enormous amount of offsetting stimulus. At this point, more than 12 trillion of that. So we did have the worst GDP contraction since 1946 last year with a 3.5% drawdown. That was difficult. We did receive, obviously, a bounce towards the back end of the year as stimulus took effect, but it wasn't enough to offset what happened in the first part of the year. However, at this point in 2021, the projections are we'll see economic growth of 7% plus, which is the fastest economic growth we've experienced since 1984, the year that Kenny Loggins, I guess, sang Footloose to all of us. Great movie. By the way, I ran to it this morning. If you listen to the tracks on that, they're just over the moon happy. And that was just a happy period. All the movies were kind of silly and fun. And so that's the way we should be experiencing 7% growth. I'm hoping that maybe y'all take that away today. But good news is it's not just this year. Next year, we should see 4% plus, which will be the fastest economic growth we've had since the year 2000, when Britney Spears released, Oops, I Did It Again. So this environment we're in is a little unfamiliar because we haven't been in an environment like this since the year 2000 at least, and really 1984 at most. All right. Now, you can't have huge gyrations like this within the economy without some consequences, okay? So I'm going to take us back to my freshman year at Sewanee economic class taught by Yasmin Muhuddin, fantastic professor. And we're just going to do standard work with economic demand and supply curves. So the economic supply curve, just as a refresher, slopes upward to the right, the economic demand curve downward to the right. And where they come together at the equilibrium point, you get, theoretically, a level of real GDP, size of the economy, and a level of prices, aggregate price levels, basically inflation. All right. So in the first part of the pandemic, we had the great lockdown. That was part one, right? So everybody went back to their homes, back to their condos, back to their apartments, and they stopped spending and just tried to see what was going to happen. The government said, look, we need to close the restaurants, close the businesses. I remember at one point there was talk of martial law. Remember that? And I didn't know, I think I was in Nashville, whether I was going to be able to get home to Memphis or not to the kids. I mean, it was crazy, right? But what we weren't doing was running out to the Bass Pro and buying kayaks and, hats and guns and things. So for a minute, we were all locked down, and that led GDP to fall, and price levels actually fell precipitously. I went back and looked at it in April of last year. Annualized price levels were falling at about 9%. So we did see a drop in GDP. We did see deflation, a drop in price levels, at least from a growth perspective overall. Part two of the Great Lockdown, employers started shedding employees, shuttering plants, and reducing overall economic supply. So remember, we went from a 3% unemployment rate to like a 15% unemployment rate overnight, a real shock to the system. Well, that was employers reacting to the drawdown in demand by the consumers. And so as supply was reduced across the economy, GDP fell even more, and we saw a little bit of stabilization in prices. In fact, by June of last year, the inflation rate was rising at a 6%. So in lockdown scenario part 2, supply fell, GDP fell, price levels started to stabilize. This occurred, and I can show you all that in the data, which I won't do, but I can do. Lockdown scenario part 3 is where we are today. There's an enormous surge in demand because remember from the 1958 experience when they opened up the marketplaces again and people were vaccinated, they went out with, gusto and spent a whole bunch of money. And so animal spirits are rising. And then you've got all of that. Remember the stimulus that they put inside the balloon that's popping to the surface. So we've got this surge in demand across the economy, and that's leading GDP to rise. And that's leading price levels to rise significantly since there hasn't been a commensurate change in supply. So as we're awaiting supply, here are just a couple of charts to chronicle how significant the moves in inflation are right now. So this is the producer price index shaving out what producers are paying for commodities. And at least last month, the year-over-year growth rate was 17%. We haven't seen surges like that in commodity prices, again, as inputs to producers going back to the late 1980s or late 70s due to the oil embargo, and then the huge spike to 150 in oil prices at the end of 2007, I believe. And so this is the largest amount of commodity inflation we've seen, except for those other 2 oil-induced events going back over the last 20 years or so, 30 years. What about wages? Yes, this is happening. So at an annualized rate in the first quarter, the employment cost indices were rising at a 5% rate. That's somewhat unnerving, highest we've seen in quite a long time. 3 reasons for that. 1, schools were basically closed, which forced people to stay home. 2, you had those who didn't want to participate for fear of catching, COVID. And then 3, you have the offsetting stimulus, or I should say extended unemployment benefits, which equate to a little bit more than $15 an hour. And I'm not including the stimulus checks themselves, which obviously increase that number dramatically. At $15 an hour, that equates to a $30,500 annual salary. And so surprisingly, about 50% of Americans actually make less than $30,100. Surprising statistic. I got it from the Social Security Administration. It was in a Friday email. I believe it to be true, although shocking. So you can either go to work for $30,000 or not go to work for $30,000. People make rational, incentive economic decisions. So that's led to some labor shortages as people opted out of the workforce. Now, all that expires September 6th. Some of the states have started to pull back on the unemployment benefits to try and add more employment supply to reduce some of these pressures. But the good news is, if you look at it year over year, the employment costs really only risen about 3%. So while it's a short-term aberration, I don't think it ends up sticking around once we get back to more normal levels of government benefits. All right. But you put that together, the combination of surging commodity prices and rising employment costs, and we do have this spike higher in core consumer price inflation. At 3%, it's not, record levels by any means, but it is a very sharp upward trajectory, as you can see, and the most we've seen going back to, call it the early 90s. So what we're doing now is just awaiting supply, right? So in the 4th tranche of this experience, we will receive a whole lot more supply into the marketplace. Lumber prices, as everybody knows, have gone through the roof. That's because 40% of the capacity was shuttered. That's all coming back online. We had a great prospect in here the other day who had a really cool landscaping business. He said all of his input costs are rising, not necessarily because of shortages, but because they could pass, price increases along. So some of this is because of shortages. Some of this is don't ever waste a crisis. If you can raise your prices, do it. The window on that is, I think, kind of closing. But as we add supply into the marketplace, that will lead to another surge higher in real GDP. Right now, the Fed The Atlanta Fed, which tracks in real time their GDP expectations for this quarter, is over 10%. And a lot of that is supply coming back online. Last quarter, 6%, that was demand coming back online. So these things are working together now at this point. And so ultimately, GDP will rise and price levels will come down. In fact, I looked at the commodity futures this morning and you could see most of them have started to roll over. The other thing that gives me some comfort is if you look further out, the market measures are not really all that concerned about longer term inflation. So this is a 10-year break-even inflation rate. If you look at the differential between the Treasury inflation protected securities and the standard 10-year, you can see the break-evens at about 2.4%. And yes, that's elevated. It's actually rolled over a little bit, which I'm demonstrating here. But those levels are not inconsistent with what we've seen going back to sort of the year 2000. And we also have the 10-year yield minus the 3-month Treasury yield, and that is the slope of the yield curve. And as you can see, during previous recessions, which I'm demonstrating in the shaded areas, you come out of recession, sorry about that. When you come out of recession, you end up with a surge higher in the slope of the yield curve. We've had a surge higher, but not to the degree we've seen in the past. And remember, the Fed is centering the short term or the short end of the yield curve, and the marketplace is setting the long end of the yield curve. And so with that, again, I don't see panic on the horizon, even though clearly there's concern. And if you look at aggregate price levels overall, on the 10-year average yield, we're at 1.64%. That is much lower than what we saw prior to the pandemic. So yields, we may have been at 1.61 yesterday, I think, haven't by any means run away. They're still behaving, and that's a good indicator that the marketplace doesn't think we're in the midst of any long-term inflation. Okay. The good thing is with the interest rate levels low, we don't have a whole lot of pressure on stock valuations. Now, I see a lot of stock market commentary saying that PEs are too high, price to sales ratios are too high, various measures that simply compare levels today with levels in the past. I think that's interesting, but it's not really all that determinate. Really, the level of valuation for stocks is determined by the level of interest rates. And right now, the level of interest rates at 2%, 1.6% is far below the earnings yield level of the stocks, which is the inversion of the PE. So if the PE is 20, their earnings yield is 5. If the prevailing interest rate environment is 2, then you'd rather own stocks than bonds. So a lot of people say, well, stocks are just as expensive as they were in the year 2000. And in some ways, that's true. PE levels are somewhat, somewhat similar, but the difference between the interest rate environment is very different. So you had wild overvaluation in the stock market going into 2000 relative to interest rates, which is what I'm showing here. But now we're about 30% cheaper than the prevailing interest rate environment. So as long as yields stay low, stock market valuations can stay high. So here's your COVID round trip. Does this make sense? The COVID round trip is the price levels will rise, probably, but not persistently, I don't think, over time. And then GDP levels are actually going to rise, but they're going to rise more, which is the environment that we're in right now. And the unprecedented level of stimulus just sort of indicates that that can continue to occur.
Hey, David, we had a question. Thoughts on how semiconductor shortages play into everything? Intel predicts shortages for 2 years.
Yeah, I mean, the cure for higher commodity prices is higher commodity prices. That leads more production online. And so you're getting more out of the semiconductors, which means maybe you need fewer semiconductors. So it's been disruptive. That was the part of the reason we had the automotive shortage. But that led to the shortage in new cars, which led to the surge, 70%, price increases in used cars. So it's a thing, but it's already in the data. So Intel's probably right. Maybe there are shortages, but shortages just lead to more supply. So I'm not really all that worried about that. I think it's a short-term disruption. I don't think it's out there longer term, or it could show up in the longer term data. So with that, unless there's another question, Teresa, I'll keep going. So I sent out in the previous weekly email that we should stop hyperventilating over inflation. And I went and did primary research because that's the only research you should do. You can't trust really anybody's commentary. And so go to the source. And so we went to the source, pulled all the inflation data, pulled all the stock market data using Ibbotson going back to 1926. And here's what I found. If you segregate inflation down to less than 1%, 0 to 1%, 1 to 2%, 2 to 3, 3 to 4, 4 to 5, and 5 plus on any given year, okay, what you find is you got positive returns on an annual basis across that entire complex. And there is a sweet spot. So 1 to 2% may be your sweet spot. That's where we've been living, and that stands to reason. And there's concern that we'll jack up rates 2 to 3%, even 3 to 4%. But please note that if you do, you still end up with sizable stock market returns. So the Fed would like us to be at 2% plus. They might even tolerate 3% plus for some period of time using their language. Well, in the past, when we've run in those environments, we've still had double-digit stock market returns, specifically small stocks outperforming large stocks, which is a good risk on sort of indicator. So I don't think that inflation in the short run will end up suppressing stock market returns, might lead to some digestion issues, which we've had, I think, over the past month. But now I think the reason that the stock market sort of gathered itself is that people have gone and done this analysis and recognized that just because inflation has ticked a little higher doesn't mean the market's ticked lower. For those of you who are fans of our work, you may have tuned in for our 2021 Outlook, Spoils of War. It's about 100 slides. We talked about the kind of environment we'd see coming out of COVID being somewhat similar to the environment coming out of World War II, in our opinion, which was last time we had a global catastrophe and really militarized government spending. And so let's take a little bit at how our predictions sort of formed with that analysis and how they're performing somewhat this year. So I'll walk you through, as a refresher, our Spoils of War playbook and update you on how our strategies are performing. All right, first, we said the economic advance, the combination of animal spirits and government stimulus is going to create dramatic economic positive growth. And indeed, the economy right now is at record highs. This is nominal, not real GDP, but real GDP will get there this quarter or next. And so the economy topped out at 21.7 prior to the pandemic trillion, drew down to 19.5, hence the $2 trillion drawdown. Right now, we're at 22 trillion. So the economy is at record highs. Earnings are at record high. So I pulled this from FactSet the other day. This is what the earnings complex will be within the S&P 500 historically, or as per the estimates. 140 is what we got into last year. Now we're tracking at 188 for this year, maybe 210 for next year, up 44% off the bottom. And by the way, those numbers continue to rise. In fact, coming into this last quarter, analysts projected S&P earnings would grow 25%. They actually grew 50%. And that's the reason that stock prices are at record highs. Crockett does love the stock market. So the Wilshire 5000 is just a broader measure of U.S. stock market activity, up 82%. I believe today we touched pretty close to all-time highs on the indices. I imagine that trend will continue until something disturbs it. And so stock prices are at record highs, which should make you feel good. And net worths are at record highs, which should make you feel really good. So if you look at household net worth across the United States of America, topped out at 120 trillion pre-pandemic. We lost a good bit of that as the stock market most came down. So 111 trillion at the bottom. And now we're back to 130 and rising at the top. So thanks to all of that government stimulus money that got transferred to us from the debt markets, we're now at 130 trillion in net worth. That is an all-time high in the United States of America. So overall, I would say riding the recovery has been the right strategy. What about don't chase momentum? We talked a lot about some of the areas of the stock market that looked a little overheated. We talked about the growth sector being the large technology stocks primarily. being a little bit extended, much like 2000. We believe in reversion to the mean theory. Therefore, you don't have to be a genius to figure out that things that rise really high probably end up coming back down. And in fact, if you look at the period between 2000 and 2007 on this chart, value outperformed for almost a decade after growth had outperformed in the late 90s with obviously the Intels of the world performing so strongly. I believe we're on that kind of rotation, and that's been a theme you've heard us talk about now for maybe a year. So momentum stocks, the large cap technology stocks, have done well. So over the past year, momentum has risen 34%, but the value stocks, think industrials, think materials, things that hurt when you drop them on your foot, those things are up 54% over that time frame. So there has been the rotation that we projected, and that has been beneficial to us and our portfolio as investors. All right, the other thing we said was that the combination of the fiscal deficit with the trade deficit, with a reopening of the world economy and a surge in risk and global optimism, should end up depressing the dollar. And in an environment where the dollar goes down, you want to own other things. So here's the dollar index going back to when we came off the gold standard in 1971. You had a surge in the 80s, and then we had the Plaza Accord and the Louvre Accord, and tried to get stability to the currency index. It didn't really get under control until the Fed sort of figured things out a little bit. But nonetheless, this is a relative measure. When the dollar goes down, other currencies go up. When other currencies go up, the dollar goes down. And right now, we're at a phase of the cycle, we think, where the dollar likely depreciates. And in an environment where the dollar depreciates, you want to own non-dollars. So this may surprise you, but over the year, the United States has been strong, up 43% in terms of total stock market returns. However, the emerging markets have been up 49%, and Europe's actually been the winner, up 50%. I can't tell you how many times people tell me that Europe can never make money. And whenever they say that, it seems to go on a tear. So anyway, this may surprise you, but the euro's been strong, Germany's been strong, and so the European stocks have actually outperformed. So if you fear a decline in the dollar, you want to own things in non-dollar. And I will say that you can own Bitcoins and all sorts of things, but I like owning companies. If you own companies denominated in foreign currency, then you get the benefit of the company fundamentals improving, but also the underlying currency strength relative to the weakness of our own dollar. So anyway, we're global investors and it's working. All right, so let's go back and see how we are positioned and whether that's been appropriate or not. To demonstrate our ride the recovery trade, I'm using the upside capture ratio. This is year to date, and it basically asks the question, if your primary index is up 100%, which is the MSCI All Cap World Index on the right side of your screen, then how's your portfolio performing? And so our upside capture ratio right now on our primary index is about 120%. If you look at the S&P, which is our secondary index, up about 115. So we are positioned correctly. We are levered to this increase in prosperity globally, and it is working out for all of us. Second major strategy was don't chase momentum. The way that I demonstrate that in terms of the way we're positioned is momentum had been large cap growth names. So here's the holdings percentage in our portfolio relative to the indices in non-large cap holdings. So at WNA, we're 30%, call it small and mid cap stocks. Our primary index, MSCI All Cap, is 14. The S&P is 14. So we are levered towards the recovery in the smaller cap names, and we think that will continue. So that's an active strategy. We are not chasing momentum. The value side of the portfolio for us, 31% relative to 27 at the all cap and 26 for the S&P. So we're expressing that view as well. So if you want to get away from the large growth box, then you migrate towards the small value box, and that's what we've done and done it deliberately. And then lastly, we want to favor weak dollar winners. The way that I can demonstrate that for you is our non-USA holdings percentage in our equity model portfolio. The MSCI All Cap's about 42. That vacillates a bit. we're not too dissimilar to that. We've got about 40% overseas. We could flex up, but I like US small caps. And then in terms of the S&P, obviously it has almost no overseas exposure, given the fact that at least by domicile, it's the 500 largest US companies. And then lastly, emerging markets. If you look at inflationary environments, if you look at weak dollar environments, if you look at early stage recoveries, emerging markets tend to outperform as they have. We've got 12% of our portfolio allocated towards emerging markets in comparison with 9 for our primary benchmark. And of course, within the S&P 500, 0. Now, these companies generate revenue there, but this is measuring things by domicile. So yes, we're expressing the views. They have been correct. I can't share the returns with you per the regulators, but you get your statements if you're current WNA clients. And so you know the numbers. All right, so here's the bottom line. It's time for us to cut loose. I want y'all to celebrate and be happy, because over the next 2 years, the economy is going to grow 7% in 2021. It's going to grow 4% in 2022. That should make you want to dance. Earnings are going to grow in 2021, 30% plus, and those numbers keep going up. And then in 2022, 10% plus, that should make you want to sing. And just to give you the actual math, the US economy over the next 2 years will grow $2.5 trillion. Okay. Corporate earnings are going to grow 50%, basically. And inflation is going to happen, but it's okay. If we go back in our, DeLorean back to 1984, there was inflation during that period. So between 84 and 89, inflation was up 3.5%, which makes Don Johnson look nervous. And the US dollar did somewhat collapse. It was down 6% on an annual basis for that 5-year period. And yet, US GDP was growing at 4.5% annualized. US stocks rose over that period 15.7% annualized. And during that weak dollar environment where we saw good global GDP growth, non-US stocks actually advanced, this is not a typo, 37.2% annualized for that 5-year period. So there are a lot of things to be unhappy about, I suppose. And there are obviously a bunch of media bullhorns trying to tell us that the world is coming apart. It's not. And if you just look at the numbers, it's basically kind of the best of times right now. So my hope is in digesting this presentation, you feel good about where we are. I do. Now, if the view changes, we can make adjustments. But for the moment, this is the status quo until something breaks, and we'll be on the lookout to make sure we get out of the way when it does. So for that, happy to take some questions and hopefully have cheered you up over the last 39 minutes.
Thank you, David. Anyone with questions, feel free to unmute your mic and ask away.
David, what's your perspective on the real estate market and, both residential and commercial, given the tectonic shifts we've seen in how people work?
Well, on the residential side, it's a good thing, right? Because people want more home offices. They want to stay at home more. So they want bigger houses, and offices, hot tubs, and all that stuff. So the uptick in residential certainly makes a lot of sense. On the commercial side, I get a little bit less bullish, just because if you're in an environment of rising commodity costs, rising inflation, and rising taxes and interest rates, that doesn't seem good for a return complex. And the commercial buyer is an economic buyer, whereas the residential buyer is a lifestyle buyer, which means they pay more attention to that stuff. So with the economy growing as much as it is, it sort of supports everything. But at the margin, it seems to me like the residential marketplace probably makes more sense than the commercial marketplace. The thing I really worry about, and I hadn't heard as much about it since I couldn't sleep for weeks thinking about it, is if they do get rid of the 1031 exchanges, or, well, let me say it this way. The effective tax rate on real estate really is about 0, right? So if you look at the industry codes and you try and figure out what the effective tax rates are, it's the most tax advantaged investment, and that's where a lot of that rate of return comes from. The government knows this. And so if they really want to, try and make the playing field more level and even for everybody, then you figure out a way to tax real estate more. So if they get rid of the 1031 exchanges, basically the purchasing power of commercial real estate falls by 40%. That would be devastating. The real estate, lobbyists would work hard to make sure that doesn't happen, but the threat is sort of circling. So that makes me a little nervous. But economics overall are good. People like real estate as an inflation hedge. I get that. I think the risk is really the policy environment. I don't know because I can't see y'all on the screen by show of hands. How many of y'all would rather be sitting in here together than on Zoom? But I'm hearing more and more that people would like to congregate. So I don't think that we'll all stay virtual forever. Commercial probably comes back, but there are some policy and tax headwinds that make me a little bit fearful.
David, should investors be concerned about the U.S. government debt and deficit?
I mean, it's the right question to ask. And the answer to it is yes, but not yet. The government is running modern monetary theory. The theory is that deficits don't matter, debt doesn't matter. The only thing that matters is inflation. With inflation expectations anchored at the moment, that gives them clear passage to print more money, buy more stuff. So right now, the data supports the premise of modern monetary theory, which is the deficits don't matter. The experience in Japan is really what everybody is looking towards. And I've asked the Fed, a couple of different people, Bullard most recently, if they'd go ahead and sort of admit this is the trajectory they're on, and they kind of won't. But they're studying Japan, and Japan continues to print money. They've got demographic issues, which they think we have as well. And we do, because the US population is actually shrinking, but for immigration. So we've got a population sort of drawdown that is suppressing inflation. And we got these other factors pressing inflation up, and the government views their role as being one of those factors. So I don't know where the tipping point is for debt to GDP at the government level. We're at 100%. Japan's at 200%. Japan's interest rates are less than ours. Japan's inflation is less than ours. So I think there are a whole lot of other factors to consider. But right now, their premise is debts and deficits don't matter. All that matters is inflation. We don't have inflation, therefore don't worry about the debts and deficits. So, conceptually, my economics department would disagree at Sewanee, but in practice, they're right now. And so that gives them more power. And so we'll watch the inflation gauges closely. Again, we've got 40% of the portfolio in alternative currencies. If the world votes against the dollar, which would have to be a massive strike because the dollar is so much of everybody's trading volume and store value and currency reserves, and the dollar is just the world's currency, which obviously gives us that reserve status. So it's a thing, and it's something that I worry about. But in the short run, the more money the government prints and hands it to us, the richer we get. So happy to receive that in the short run and figure out how to duck the consequences in the long run. But yes, I'm thinking about it. When I asked Bullard what ultimately would happen, and it's on the Fed's site, he didn't really have an answer. I mean, they don't really know either. We're sort of off the map in the way that the governments are handling the economy. But I continue to be bullish in the long run because per capita GDP across the planet is still less than 10,000. Ours is at 60,000. As the world matures, that gap is going to close. So the world economy is going to continue to grow. Who the winners and losers are at times unclear, which is why we own all of them.
Do you see crypto continuing to play a role or starting to play more of a role? Obviously, it's had a pretty good run up until the last few days.
Well, so here's my somewhat entertaining answer to that. I don't own any cryptocurrency. I'm happy to make double-digit returns a year in stocks and stuff. But if crypto does receive a lot of attention, So next week I will be attending the Bitcoin conference with a whale pass that I got from a buddy to see what they have to say about all this stuff. Now, is it a store of value? Is it digital gold? Maybe, but it just dropped 50%. Does that make you comfortable? I don't know. A store of value should be theoretically a little less volatile, but gold bounces around too. It's not a currency because you can't really spend it. I know you can buy 1 week a Tesla and then the next week not a Tesla, but it's not really a currency. And so I don't know as a medium of exchange if it's really that good. So it ends up kind of reminding me of a collectible more than anything, or just flat out security that trades on speculation. Blockchain, I think, is for real. So I think that registry system that underpins or enables the Bitcoin or all of the cryptocurrencies is legitimate. And I think we'll see more adoption of that as we go forward. And I think that's good. I think it'll reduce a bunch of friction across the economy. There'll be a lot of intransigent interests that try and forestall those market share gains like the stock exchanges, et cetera. So anyway, I'm kind of bullish on blockchain as a concept. On cryptos, I don't really know. So the other day I sort of proposed that the hedge funds probably got beat up in that GameStop thing, which made them mad. And if I was one of those guys, I would have pulled my buddies together at a steakhouse in New York and I would have said, hey, here's what we're going to do. We're going to pump up the price of Bitcoin. We're going to suck all these Robinhood traders in, and then we're going to flush it and punish them. Now, I don't know whether that happened or not. What I do know is that the market cap of all the cryptos is between 1 to 2 trillion. And if you took a big bunch of hedge fund money and levered it up, you could be pretty meaningful in that marketplace. And by the way, the regulators can't really see into it all that great. So it provides the excellent opportunity to manipulate the market in a significant way. So, until it gets some regulatory superstructure around it, or people get more experience with it, or the market capitalization gets much larger, it's just an open playing field for market manipulators. So that part of it, to me, makes it somewhat of a curiosity rather than investment for us right now. But again, I think the blockchain stuff is real. Figuring out how to make money on that, I'm not real clear on, but I'm going to go to Miami. Super grateful for all of you guys. Hope you feel really excited and bullish about what you heard here. I'm not projecting the market goes up 50% tomorrow, but what I am saying is that things aren't ready to collapse. We're in the sweet spot of the cycle right now as supply recovers, and y'all should take that into what should be a very nice and prosperous and leisurely summer. Thanks for the attention and for trusting us with your capital.
All right, everyone, have a wonderful day. You can find us on wealthstrategist.com if you have any more questions.
Thanks, everyone.